I'm Hiro Silva, and this is your structural look at the U.S. stock market. Let's get right into it. Some weeks really do feel just like that. And this was absolutely one of them. It was a week just full of deep contradictions, of conflicting signals that really force you to look past all the daily noise and ask a much bigger question about where capital is truly flowing. Because this really wasn't one market story. It was two, happening at the exact same time. And the division between them, well, it was stark. So on one hand, you had the Dow Jones Industrial Average just pushing right past 48,000 to a new all-time high. Incredible. But on the other hand, the tech-heavy Nasdaq was falling for 4 straight days under some really persistent selling pressure, a clear and pretty dramatic divergence. And the headlines that were fueling this split were this strange mix of relief and, well, anxiety. We dodged a government shutdown, which was good news, but at the same time, any hope for a December rate cut from the Fed just kind of faded away. This created some sharp volatility in the big AI stocks and sent money flowing into quieter, more defensive areas like healthcare, which actually outperformed. So the big question is, why is this happening? What are the underlying forces creating this split personality in the market right now? Well, I think it comes down to 3 main things. First, the movement in bond yields and what that tells us about Fed policy. Second, a very clear rotation into defensive sectors. And third, a real reevaluation of just how high the valuations on some of these AI stocks have become. So let's start with that first one, interest rates. The 10-year Treasury yield climbed this week. That was a reaction to stronger economic data that makes it less likely the Fed feels any pressure to cut rates. Now here's why that matters so much for stocks. Higher yields on safe government bonds create competition for your investment dollars. They put direct downward pressure on high-growth tech valuations because the value of their future profits gets discounted more heavily. Put simply, when safe returns go up, risky future growth just becomes less attractive. And this pressure on tech is causing what we call a classic sector rotation. Simply put, investors are moving their money. They're shifting capital away from sectors that have had a huge run, like technology, and into sectors they see as safer, or maybe just a better value for the current environment. So when you put all these pieces together, the diverging indices, the rising yields, the sector moves, a really clear signal starts to emerge from all the noise. What's the fundamental message that the collective action of millions of investors is sending this week? The market is telling us that a major structural shift is underway. This isn't just a one-week event. It feels like the potential start of the Great Rotation, a significant flow of capital out of those high-valuation growth stocks and into the more defensive, value-oriented parts of the market. Okay, so how do you think about this for your own portfolio? This isn't about prediction, right? It's about preparation and having a framework that works for your own personal strategy. So let's look at a few ways to approach it. If your top priority is preserving capital, a defensive stance could mean strengthening your positions in areas like healthcare and consumer staples, maybe even holding a little more cash. For a balanced approach, the focus might be on rebalancing, maybe trimming some of that high-flying tech exposure and adding to those same defensive areas. And if you're a growth investor, well, this environment could be a dual opportunity. You can use the volatility to buy quality AI names on dips for the long term, while maybe actively participating in the shorter-term rotation. All right, looking ahead, there are a few key data points coming up that will either confirm this rotation idea or, well, challenge it. So here's what's on the horizon. First, we've got the Consumer Price Index, the CPI. That's going to give us our next big read on inflation. Then we have retail sales data, which tells us a lot about the health of the consumer. And finally, of course, we'll be listening to any and all commentary from Federal Reserve speakers for clues on what they're thinking about future rate policy. Ultimately, whether this rotation has a real staying power, that's going to be a key theme in the coming weeks. If this structural analysis helped your thinking, please subscribe. I'm Hiro Silva. Thank you.